Hello, everyone. Welcome to Accounting 415, Advanced Income Tax Theory and Practice. For this video, I'm going to go over the syllabus and a course schedule very quickly and to highlight a few items before we get to the Business Entity Overview, Chapter 15. Okay, let's take a look at the course schedule. The course is broken down into three big parts. One is the corporation. The second part is the flow-through entities covering the partnership and S-Corp. Then the final parts of the course are going to cover the state local tax and international taxation, as well as the state and GIF taxes. There will be only one final exam. It's a cumulative exam to cover all the chapters except 15. Chapter 15 is really an intro chapter to give you some of the basics regarding the business entity legal classification and tax classification. And let's take a quick look of the syllabus here. I'm going to bring that over. So the syllabus is very much tied to the course schedule. The only thing I want to highlight here is this is designated as a HIP course. So it's, in other words, it's a business, it's a high impact practice course. Because of this designation, I did make some updates on the assignment design to make it more interactive. And so I have a chance to kind of interact with you more and through a multiple round. And I really encourage reflection and apply the knowledge, through the Excel simulation, all the different things. So that's why I'm kind of adopting some new assignments beyond what's already in Connect. So that's why you will see the grade description is a little bit different from what you have seen in the individual taxation. I will post a video lecture for each chapter because we're going to cover 10 chapters in total, and there will be a play pilot quiz built in those video lectures. And the conceptual quiz is need to be completed at the beginning of the chapter after you read the textbook and watch the video lecture before you get to the homework. And once you have some basic understanding of the chapter material, then you're going to move on to the homework. And in addition to the homework in Connect, you are also going to perform this tax calculation in Excel. I will provide some template or additional guidance as far as how to do this. But the tax calculation problem is aligned with the homework in Connect. So you have the choice to either complete the tax calculation first, or you can complete the homework in Connect first. Those two go hand in hand. And the tax research and return project, like we specified in the course schedule, will be more comprehensive tax problems, either for a corporation or for partnership. And this group project is set up in a way for us to learn from each other, and you will also get a chance to get some feedback, from the initial draft. So really, we're kind of working on this together, and those projects are already posted in Canvas, so you can take a peek and start working on those. While you start on on each module. Again, there's only one final exam. It's open book exams like what you have seen in the individual taxation course. Okay, now I'm going to switch gear and move on to the business taxation overview. For each chapter, the PowerPoints, at the beginning, I will provide this knowledge map and some of the fundamental concept, way kind of help you build this big picture, what this chapter is about. And I hope this knowledge map will help you to kind of guide your reading and understand the context of the materials a little bit more. So for chapter 15, again, this is an intro chapter for business entity taxation. It start off with the classification of the business entity. One side is the legal classification. You know, legal. There's a lot of material covering the legal implications of the business entities, and the legal implication focuses more on the responsibility of the business, especially in terms liability, right? Who's responsible for the liability? Is the business or the owner? Any legal arrangement among owners, and how do how the profit is allocated, and how the dividend is paid, and how the distribution is made, and all those legal issues. And the tax implication is something, of course, for a taxation course, is something we're going to focus more on. But to notice the legal implication, a lot of times kind of leads to the tax implication, because those two kind of go hand in hand. But that's why it's really important to understand kind of the legal entity setup, and before we get into the tax implication. From a tax perspective, really from a business entity perspective, business taxation perspective, we need to understand whether this entity is paying tax or not paying tax. If they're not paying tax, more than likely it's a flow-through entity, and the owner will pay tax. And the third type is the tax exempt entity. That means the entity by itself is exempt from taxation in general. So again, when you read the chapter, you want to kind of really put a special focus on the tax implication, because we're in a taxation course. However, it's good to understand the background of the legal implications, because the legal implications could have a bearing or impact on the tax implications. The next thing I want to kind of highlight here is the tax election, the check the box regulations. So in a lot of cases, the from a tax perspective, the business entity or the owner of the business entity has a choice to make an election just for tax purposes. So to sum it up, really there's two types to start out. One is the corporation. The other one is when the business entity is not a legal corporation. There are different options. So if it's a legal corporation, this corporation can be elected as S corp, and but if there's no elections made, the C corp is the default treatment for tax purposes. If it's not a legal corporation, then the they can elect to be treated as a C corp on Form 8832, and S corp. The entity can also file election to treat themselves as a S corp. And generally speaking, if the entity has more than one owner, will be treated as a partnership. And if it's a single owner, very likely it will be disregarded for tax purposes. And so this is really kind of the tricky part, and to understand, how this legal classification and a tax classification, how those two overlap, and but though at the same time they're a little bit different. Why it's super important is because depending on the entity legal classification, the non-tax characteristics could be different, and the legal arrangement among owners could be different, and the responsibilities for the liability of the business could be different. So this is really a legal classification. But the tax classification is another layer, and I think this chart here is really kind of give you a quick overview of how this is done. Okay, So generally speaking, we start with all the different type of legal entities. So legal entities, either business with a single owner, or LLC with single owner, or LLC with more than one owners, or partnership, either LLP, LP, or general partnership, or corporation. So the arrow here where I'm linking to is basically suggest if there's no tax election made whatsoever, then the default tax classification is 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 indicated as what's showing on this PowerPoint, and either they will be treated as a 1040 Form 1040 Schedule C as a disregarded entity. They do not need to file a separate business return. Either they will be treated as a partnership, then Form 1065 will be required, and the corporation, if it's a corporation legal corporation, it will be treated as a C corp, and the Form 1120 will be required. And next, we're going to move on to some kind of this election, right? So this is saying, okay, if the LLC with a single owner, they also have the option to be treated as either S corp or C corp, which is very unusual, but it can be done. The LLC with more than one owners, it can be treated as S corp or C corp, and partnership can be also treated as S corp or C corp, and the corporation can be treated as S corp. Again, from this chart, you can see there are some overlap between the legal classification and tax classification. This is a portion I think it's a little bit confusing, and at the same time, uh, it deserves some attention because especially regarding the business formation, a lot of the business owners are going to ask, okay, which entity should I set up for legal purposes, and then what's the tax status, right? There's some flexibilities regarding the tax status due to the tax election uh, available. Okay, so now let's take a look at the key difference between the C corp and the flow through entities, because we spend the first 3 or 4 weeks on the C corp, the corporation. Really, we're talking about C corp. When we talk about corporation, we're really talking about C corp. So C corp is a tax paying entity. So therefore, there's entity level tax. There's also double taxation, and the shareholder and owner taxation level. The shareholder has to pay tax on dividends and stock sales, and the shareholder owner's basis, the entity income has no effect on the basis. For the distribution from the C corp, normally will be treated as either dividend, return capital, or capital gain, and the QBI deduction is not available for C corp. Those kind of summarize kind of the main difference between the C corp and the flow through entities. We'll get into those different points in more detail when we get to the corporation chapters. But again, this is something that's high level to highlight the differences between the two types entity, C corp and flow through entities. And side by side, you can see for flow through entities, there's no entity level tax. Therefore, there's no double taxation, right? So the tax is only assessed at a shareholder level. And the shareholder will pay tax on the allocated income during the year. So even though the income is not distributed, the shareholder or the owner of the flow through entities has to pay tax on the allocated income. And accordingly, the shareholder owner basis will be adjusted by the entity income and loss allocated to the shareholder or owner. And from a distribution perspective, this distribution will be treated as either a return on capital or capital gain. Really, there's no dividend applied in this case. And the QBI deduction is available to the business owners for the flow through entity. So this is something uh, at the beginning you may not see, okay, why there's such a difference, why those the different implications apply for those entities. But once we get into the chapter, you will learn more, and we'll have a deeper dive on those topics. And the tax exempt organization, this is regarding the nonprofit or universities or religious organization, and the Form 990 filing requirements are generally required. And again, we're not going to spend a lot of time on the tax exempt organizations per se, but uh, we just need to know for business entity taxation, the, the, the taxation for nonprofit, it's a separate topic. The other thing the chapter talks a lot about is regarding the tax treatment on the owner compensation. This is very much ties to kind of double taxation versus single level taxation implications. In addition, the owner compensation will trigger the self-employment tax and a FICA tax, and also the deductibility of this owner compensation. All these issues uh, are discussed in detail regarding the owner compensation. This is something, again, this is also a very important characteristics uh, to consider when the business owner is trying to consider which form of the business entity they want to choose. Other considerations. This is something we're going to dive deeper when we get into the specific chapters. But overall, from the life cycle of the business, really, at each stage of the business, the tax consideration are slightly different. And generally speaking, at the initial setup stage, really what we're concerning more for tax purposes are regarding the owner contribution of property to entity, and whether there's any gain or loss recognition at the owner level, and how to establish the tax basis of owners' equity interest. Uh, as you see in the chapter description, you will see, the entity formation and the gain loss recognition and the basis. Those keywords come up over and over again. Again, no matter what business entity we're talking about here, those type of things, always apply. And the next is once the business is set up, then from a business perspective, if there's a separate tax filing required, for instance, 1120 or 1065 required, then you need to choose, the business need to choose the tax year and accounting period, and try to figure out, okay, how to derive the taxable income, and how to allocate the income loss to the owners during the tax year. And from a distribution side, if there's any non-liquidation distribution of cash or non-cash property to the business owners, how to treat those distributions from the owner's perspective and from the business perspective. And finally, when the business wound up, or at the end of the time liquidate, and there's liquidation distribution, what's the impact of the liquidation distribution from a business owner's perspective as well as the entity's perspective. So again, the property taxation concept kick in when we talk about distributions, no matter whether it's a non-liquidation distribution or liquidation distribution. The central theme is the gain loss recognition, or uh, and correspondingly, the basis of the property received in the distribution, or the shareholder or owner's basis of the business entity. So all those things are intertwined. And as you can see here, a lot of the tax concepts we're talking about here are transaction driven. So that's why it's very, very important to understand what transactions we're talking about. And are we talking about distribution? Are we talking about formation, contribution, or what it is? I think some business background about the business formation and its distribution will be really helpful for us to understand before we get into the nitty gritties of the tax implication. Okay, I think that's all I have for this chapter. Thank you so much for listening.